So welcome to our webinar on how to maximize your tax savings as part of our Business Building Basics series. My name is Adi and I'm a brand manager at Taylor Brands. So for those of you who are new to our community, welcome aboard. We're very happy to have you with us. Taylor Brands is a business building platform that simplifies the business journey for business owners. So whether you're just starting out with your business or maybe you've already been in business for a while, we're here to help guide you through every step of building your business. Our mission at Taylor Brands is to simplify your business journey. We want to give you all of the tools and all of the tips that you need to manage your business as well as you can. So we all know that tax season is here. And of course, taxes are a super huge part of any small business. And that is exactly why we brought on the experts from 1-800 Accountants today to help us understand how we can maximize on tax savings. So slight change of plans. We have here from 1-800, Elliot won't be joining us today, but we do have Gary Milkwick, who is the Chief Finance Officer at 1-800 Accountant. He is an experienced CPA and our go-to man for all tax-related questions. And we are super happy about this partnership with 1-800 Accountant because of their expertise in taxation and accounting, especially for small businesses. So this partnership really brings a huge value for our customers, and we're very excited about this.
Excited to be here. Thank you.
Thank you, Gary. All right, so a bit about what will happen today. We have an agenda of very interesting topics that we all really need to know. Gary will guide us through all of the tax-related topics today. And please stay tuned throughout his presentation. And afterwards, we will present you with an amazing offer that we have available for everyone today. And if you have any questions, please feel free to write them in the chat. I see that it's already active, so keep it going. We will try to answer some questions throughout the session, and the rest of the questions will be addressed by Gary, or most of the questions at the end of the session. And just a heads up, if you will have more questions afterwards, we're always here. We have an amazing support team, so we're gonna be able to get everything answered for you. Okay, so just a bit of a deep dive into why Taylor Brands and 1-800 Accountants partnership really is the perfect fit for small businesses. So on one hand, we have Taylor Brands with our guided business building platform. And that basically means that we are able to provide you with customized plans specifically for your business needs. And that includes round-the-clock support, making sure that you have everything that a business owner needs and that everything will be available to you at any given moment. So as part of this offering, we've partnered up with 1-800 Accountant, as I've mentioned, and they really are the best in the game when it comes to taxes and accounting for small businesses. It really is the best you could ask for when it comes to your taxes. So this partnership together will allow you to get all the expert tax assistance that your business needs in a super simple and guided manner, which is really what we all want. So this will include applying for tax services directly through your Taylor account, speaking to a tax consultant at any stage that you need, and having all the support that you need throughout the entire business building process. So without further ado, I'm super happy to pass the mic on to Gary, who will continue the session for us. Thank
awesome.
You, Gary.
Thank you very much. I appreciate it. Sorry you guys didn't get Elliot. He's been doing this. I used to do this a lot. He's been doing it a lot more recently. So we'll see if I'm super rusty. You'll have to let us know. But anyways, what we like to do is do an example to when we're kind of explaining some of these concepts. There's a few things as a business owner. I've worked with hundreds of business owners over the years, and a lot of people when they first start working with an accountant, a lot of people don't even know what questions to ask. It's like, I've started a business. I don't even know where to start. I'm great at the restaurant industry, or I'm great in this example of creating these soaps and wax, but I have no idea from a tax and accounting perspective what I need to be doing. I don't want to get in trouble. I don't want to spend a lot of money for a lot of clients. Taxes are their single biggest expense. So, it's super important. So we're going to kind of go through an example as we're talking about this stuff. I'll give more examples. As we mentioned in the chat, if you have additional questions, we'll try to get those at the end. If they're super specific, it's hard to, answer a super specific question to you without getting into really deep dive of your personal situation. But, if there's general questions, we'll try to answer as many of those as possible. So in this situation, we've got Mel Soaps and Wax. It's a digital company that creates and sells soaps, candles, other home improvement products direct to consumers through their online store. So we're going to kind of go through Mel's requirements as a business owner from a tax and accounting perspective, and how she can save money. I'm sure some of you are doing retail, others may not, but the vast majority of the stuff that we're going to talk about applies to nearly every industry. All right, so this is something that we do with all our new clients, and most accountants will do this, go through some discovery questions with the client. So for Mel, this is her first business. It's an LLC. Most people we see are setting up LLCs. LLC is a very flexible entity type as far as taxation goes. It can be taxed in many different manners, which we'll see later in the presentation. What industry is this business in? It says other here, but that's that. Retail is probably retail online. State of incorporation, Massachusetts. Startup costs for this business is $10,000. Mel's got a projected revenue of $25K, a first year profit of $10,000. One employee. She is married, filing jointly with her spouse. Has $50,000 of W-2 income, no rental properties, and she works out of her home and uses a vehicle for work. So if you have any of these similar situations, the revenue and profit doesn't matter that much, but we're going to talk about home office, vehicle use. So a lot of business owners that we work with have those things. So hopefully this will be helpful, and almost all businesses have startup costs as well. So we're going to talk about how to save money on taxes with all of these things. So the vast majority of entity types that small business owners use are called flow-through entities. The only entity that you may be familiar with that's not a flow-through entity, other than complicated trust, is a C corporation, and the vast majority of new business owners don't do that because there's double taxation, which we're not going to talk about today. But a flow-through entity like an LLC. Basically, what that means is the profits and or losses flow through that entity's tax return to the tax return of the business owner. So these flow-through entities don't pay income tax at the entity level. Those profits and or losses go to your personal tax return and add to or subtract from, if you have losses, your other income that you might have. And then everything's totaled up on the tax return, and then you pay taxes based on that netted number. The second bullet point there, the owners pay taxes on their share of the income. So, if you have a partnership, the two partners will get their share of the profits and or losses. And if there's profits, each partner will pay on his or her tax return their share of the income taxes for that partnership. It's not paid at the entity level. All right, so the first thing that we're going to talk about is super important, and it should be one of the first things that you do after you set up your entity. So there's a thing called an entity classification election. So again, going back to Mel, she has an LLC, as I'm sure the vast majority of you guys here on the webinar also have an LLC. The good thing about an LLC is they're flexible, as I mentioned earlier. And what does that mean? It means that you can choose how your LLC is taxed. If you don't choose, the IRS basically chooses it for you. So, for example, in Mel's case, she's the single owner of her store, of her business. If she doesn't do anything, she's going to be taxed as a sole proprietorship on a Schedule C on her personal tax return. Now, I guess the advantage to that is it's simple. The disadvantage is that she's going to be paying more in income tax than she would need to, because on a Schedule C sole proprietorship, you are subject to self-employment taxes of 15.3% on top of your income tax. So if you're in a 25% income tax bracket and you also have to pay the 15.3% self-employment tax, that adds up quickly and becomes a significant amount of tax. Let me go back here and make one other point. So the key point here is that you need to take action within 75 days of the date the business is formed. Now, if some of you sitting here may be thinking, oh crap, I didn't set this up and it's been more than 75 days. There are ways around that. You can get a late filing election, but best practice is to get it knocked out from the beginning so you don't have to do the extra legwork to get an exception for. But my point there being, don't despair or give up or ignore it if you've missed that 75 days, but get it taken care of as quickly as possible if it makes sense for you to do an election. And we'll cover that now, like what that means. So as I mentioned, self-employment tax. So self-employment tax is made up of two components. And the way I like to explain this is if you're an employee working, let's say I'm an employee working at Microsoft. Microsoft is paying me a salary. They're withholding Social Security and Medicare tax, right? That's the FICA that you see here, Federal Insurance Contribution Act. So FICA is made up of Social Security and Medicare. If I'm working for Microsoft, they're withholding 7.65% of my salary for Social Security and Medicare. Then they're also withholding federal income tax. They're also withholding state income tax. And then I get a net check at the end of the day, so if I was going to get paid $6,000 a month, I may only be taking home, $4,500 or whatever the number is. I'm sure you guys are all very familiar with W-2 jobs. So that's how that works. If you're self-employed, and in the case of Mill, an LLC operating as a sole proprietorship is considered a self-employed person if she doesn't make the entity classification election, she has to pay the 7.65% plus the employer's 7.65%. So rewinding to my Microsoft example, if I work for Microsoft, when they withhold that 7.65%, Microsoft, the employer, matches that 7.65%, and they take all of the money and jointly put it into the pot for Social Security and Medicare. So that's kind of how that works. Now, if I'm a self-employed person, I have to pay the employee and the employer's portion of that tax. So in this example, if you earn $20,000 as an LLC, you don't do any sort of entity classification election, you're on $20,000, 15.3% is going to be $3,060 in self-employment taxes. Now, keep in mind, that's in addition to whatever your income tax rate is for federal and state income taxes. This is just Social Security and Medicare. Now, if you set up an LLC and you had it taxed as an S corporation, which is, I'll get into a little bit more detail about how exactly the mechanics behind that, and you earn $20,000, you could allocate a portion of that $20,000. In this example, it would be you'd allocate $10,000 to what's called salary, and you're only subject to paying self-employment tax or FICA on $10,000 instead of the 20. So you'd save about half of the self-employment tax. So you'd save, that $1,530 every year. And as you make more and more money, that's a bigger and bigger savings. Let's think of if I made $100,000 as a single member LLC. If I did nothing, 15.3% of $100,000 is $15,300, right? If I don't do anything. If I did what's called an S Corp election and paid myself a reasonable salary of about half of those profits of $100,000, so I set a salary to myself of $50,000, then in that situation, I would be saving over $7,000 just in Social Security and Medicare taxes. So, I guess that's one of the points of this slide is it's not just income tax that you're thinking about. It's also Social Security, Medicare tax, franchise taxes, sales taxes. There's other types of taxes that you can save on that can have a big impact on your bottom line. All right, so now we want to talk about some deductions that are available to small business owners. Now, in general, people ask me, well, what's a deduction? By definition, for the IRS, a deduction is anything that is ordinary and necessary for your business. Is it ordinary in the industry you're in and for business in general? And is it necessary for the business? So, for example, if I'm going to buy a phone that I'm using for business, that is ordinary and it's necessary. If I don't have a cell phone, I'm in this day and age, I'm not going to be able to conduct much business without a cell phone, right? So anytime, as a business owner, I've owned lots of businesses over the years, and as a business owner, every time I'm buying something, if I'm going out to, let's say I go to Walmart and I've got to pick up some office supplies and groceries, I will literally separate out. I have like a separate little area in my cart for business expenses because I want to put those on my business credit card or use my business debit card or whatever when I pay, so that it's not mixed in with everything. So I'm not missing out on those deductions. So again, every time as a business owner, you're making an expenditure, think to yourself, is it ordinary and necessary? And the additional question I always ask myself is, how would I explain this to an IRS agent? So as an accountant, I've dealt with hundreds and hundreds of clients over the years, and I had a therapist once. She had her own therapy practice. And she said, well, I have a jet ski, and that's necessary for my mental health. Now, is it ordinary? My response was, well, is it an ordinary expense? Is it ordinary for a therapist to own a jet ski and deduct it in his or her business? And she was pretty insistent that it could be ordinary, but I was like, no, I'm not going to help you deduct that one. But that's the question you need to ask. So anyway, today we're going to go through some very specific ones, just so you have an example of some of these expenses that are applicable to a lot of people. So startup expenses, these are expenses incurred kind of before you get the business up and running, and maybe even before you set up your LLC. You often incur costs as you're researching what industry you're going into. You might get some sort of subscription. I have a realtor friend that recently set up a business, and she, got a subscription to MLS before she set up her LLC, and she was, making payments on that. So those types of things before your business is organized and to get it up and running are startup costs. A lot of people use their personal auto or an auto in general in their business. We'll talk about how that's deducted. The home office deduction. A lot of people work from home, especially now post-COVID. There's more people working remotely than ever, so the home office deduction is important to understand. And then there's this code section 199A deduction, which is a new deduction introduced in the 2018 tax cuts for business owners. And we'll talk about that one as well. And that should apply basically to everyone here, literally. Anyone who has a profit. So let's start by talking about the vehicle deduction here. So a lot of people ask me, I've probably gotten this question literally maybe over 1,000 times over the last 20 something years. So a lot of people say, okay, my car, good example. My son, literally his car engine blew up today. He's a sound engineer, and he drives almost 100 miles a day for work because he runs sound at a live music venue. And he said, Dad, he's barely started, so he doesn't really, know this stuff yet. Like any good father, I've tried to teach him over the years, and like any normal son, he ignored me for the most part. So now he's wishing he wouldn't have ignored my interesting tax chats. But he said, okay, my engine blew up. What do I do now? I'm going to buy a car. I'm use it primarily for business. How do I deduct those expenses for my car? Do I buy the car in the business name? Do I buy it in my personal name? So there's two major ways you can take deductions for your vehicles. One is the standard mileage rate. And basically that one's as simple as saying, how many miles did you drive for business? And you can calculate this monthly, quarterly, annually. And basically you say, okay, a couple different ways you can do it. You can actually reimburse yourself personally for that mileage, or at the end of the year, you can just take a deduction without actually cutting yourself a check, a deduction on your tax return. A lot of clients I deal with actually like to pay themselves mileage on a regular basis, because it's an expense for the company and it doesn't count as income for you as the personal business owner. So it's kind of a nice situation. So in this example, we've got the business owner driving 300 miles per week times 52 weeks. That's 15,600 miles. If you take the mileage rate, that's updated every year, 65.5 cents per mile in this situation, times 15,600 miles. That gives you a deduction of $1,000. So not bad. That's going to save you, probably at least a couple $100 in taxes by taking that mileage deduction. Now, the other way you can do this is take the actual expenses of the vehicle. So you can basically take the cost of the vehicle, and basically what you would do is depreciate that over a certain number of years. Now, I'm not going to get too terribly detailed in the depreciation, but just know, for example, if I've got a $20,000 car, even if I don't pay $20,000 in cash, even if I take a loan out and I'm making regular car payments, I take that initial purchase price and I can deduct, let's say it's a little more than this, but let's just say 1/5 of it. So just to think about it easily, that it's deducted over 5 years. It's actually a little bit faster than that. It would be more than a fifth. But if you were using straight line depreciation, it would be 1/5 of that 20,000 I could take immediately. Now, there's actually an exception for cars that are over 6,000 pounds, which is why you'll see, people who, the car manufacturers who develop vehicles that when they came out with this exception of cars weighing more than $6,000 being 100% deductible immediately. All of a sudden, mysteriously, these cars that weighed 5,000 pounds now weighed 6,001 pound because they're targeting business owners, right? It's like if I buy a 6,000 pound SUV, Ford Expedition or whatever, Escalade or whatever's big heavy car, the loophole basically is that businesses that use construction equipment have heavy equipment, and so the tax code assumes if you have, and it's completely legal, if you have over a 6,000 pound vehicle, you can write that off immediately, the business portion of it. So if you drive it 80% for work, you could write 80% of the purchase price off immediately. So that's kind of an extra thing on top of what we're talking about here. But I think it's important for people to know, especially if you're thinking of buying a new car in the next year or two. But on this actual expenses, in addition to getting the actual purchase price of the car written off immediately or over 5 years, you can also take all of the fuel and maintenance, gas receipts, oil changes, tires, tune-up, maintenance costs, pay for it all with the business. And then at the end of the year, you can do a calculation and say, okay, actually, I only drove business 75% of the time. So I paid for that all with a business. So at the end of the year, I'm going to let my accountant know that we need to back out 25% for personal use. So if I had $10,000 of, car insurance also, that's one that's not even on here. Car insurance would also be an acceptable expense. The interest, if I have a loan on a vehicle that I'm paying off, a car payment, if I got a $500 car payment and, $200 of it is on average on interest for a given year, then all of that's tax deductible. But it's based on the number of business miles versus total miles. So if 80% of my mileage was for business purposes, I'll be able to take those actual expenses, 80% of those, and then back out 20% for personal use. Hopefully that makes sense. The home office deduction, this is one that applies to a lot of people now, and there's two ways to deduct that now. Back, the original method was the regular method shown here on the slide. You deduct a percentage of costs that you are using for business. And how do they calculate that? You basically take the square footage of the home that you're operating out of. So let's say I'm in a 2,000 square foot house and I'm using one bedroom that's, 300 square feet. I would take 300 feet divided by 2,000 feet to get the percentage of business use. And then I would multiply that times all of the rent, the interest on the mortgage, property taxes, utilities, et cetera, devoted to the business use. So trash pickup, sewer, water, like all of that stuff, homeowners insurance. I'd be able to take a percentage of all of that. Now, in practice, that's not fun to do, right? Track every single expense you have for the house and then multiply it by a business percentage. So what the IRS did, this was probably 10-ish years ago, they came up with a simplified option and said, okay, in this situation where you've got a 300 square foot room that you're using exclusively for business, we're just going to let you take $5 per square foot. So that's going to be $1,500. Now, the good news is you got a choice here, right? So if you live in like a high cost area, like, I've had clients who have a 2-bedroom small apartment in California, and they're operating in literally, 30% of their apartment is a bedroom that they're using exclusively for business, and they're paying $4,000 or $5,000 a month in rent. 30% of that, 30% of $5,000 is $1,500 times 12. That 12 months out of the for the year, that's a huge deduction. Now, it's important to note that for the home office deduction, you can't take more than the total profit of your business. So you can't create a large loss by doing the home office deduction. It basically, that whatever loss you would have had from the home office deduction would carry forward to the subsequent year. So that's a general idea on how the home office deduction works. I'm not able to read all of these questions as I'm going through it, but I did just happen to glance down and saw, if my bedroom is my office, like a 1-bedroom, could it be deducted? That gets tough because what it's supposed to be is exclusively used for business. So what I would say is, if you have a portion of that 1-bedroom, I would use that portion of the bedroom, the square footage of that portion of the bedroom for your home office deduction. I have some, some of it's, sometimes it's just kind of like what makes sense, right? If I have a 1-bedroom apartment and I'm operating out of it, it's going to look a little weird if I have this massive home office deduction. So, the accountant would work with you to say, okay, that's going to be a red flag, or they would probably help you come up with what makes sense. But yeah, in general, if you have a specific area that's devoted to your home office, that's what you should deduct. So if it's a portion of 1-bedroom, I would just take the square footage of that portion that's exclusively used for business. All right, let's keep moving. And I'll try to get to some of these other questions at the end, as we mentioned earlier. So paper losses. So the interesting thing about, and one thing that can be really helpful in tax planning, is that you can have losses on paper that don't represent actual economic losses to you, or cash losses, right? The example I like to use for paper losses is, you may have, let's say you have a rental property. I would imagine at least a couple of people, if not more than a couple of people, have rental properties. Your rental property could be producing income to you every month. Let's say, after you collect your rents minus all your expenses, you're left with $1,500 a month after taxes and property taxes and after everything. So you're pocketing $1,500 a month. Well, for your tax return, you're able to take tax depreciation for your house. So even though we know economically the cost of real estate is going to go up over time, for tax purposes, the value of your physical structure for your rental property is actually deducted over 27 and a half years for residential property. For commercial, it's 39 years. But you get a deduction for, so if you bought a house for, I was going to say 200, that you can't hardly buy a house for $200,000 anymore, but let's say you bought a house for, $400,000. You would allocate a portion of that to land, which is not deductible. So let's say the lot you could have bought for, just to use round numbers, $100,000. So $300,000 structure. That $300,000 structure, we know it's going to increase in value over time. But for tax purposes, you're going to get to take a $300,000 divided by 27.5. You get to take that as a deduction. So on paper, you might have a tax loss, which helps offset other income. But a gain, you got that $1,500 a month in your pocket. So that comes in really handy for tax planning, right? Other examples are stocks, real estate, things decrease on paper, but you don't actually realize those losses. If I'm holding Microsoft stock and it goes down in value, I don't get to take a loss for that until I sell it. That's when the loss is what they call realized. So that's kind of how that works. So that would also be a paper loss until it's sold. So if you're looking at the paper loss formula, you take all of your income, your W-2 and 1099 income, you add any other taxable income, you subtract your standard or itemized deductions. And these are personal deductions. This is what this is talking about. You either take a standard deduction, which is based on whether you're filing married, jointly, or single, or head of household, the different filing statuses, or you take the sum of your itemized deductions, your state taxes paid, your property taxes, charitable contributions, things like that. So whichever is greater, you get to take the greater of those two things. So you subtract that, and then you subtract any business expenses that you have, and that gives you your adjusted gross income. And that number, the adjusted gross income, is really important because that's what a lot of tax calculations are based on. Okay, in this example, we've got $25,000 of income minus $10,000 of business expenses, and that's giving us an adjusted gross income of $15,000 in this example that we're doing with Mel's Soaps. Okay, tax filing and deadlines. We're going to talk about some deadlines and things for the ECE. We're going to talk about business, federal, estate, and personal, quarterly estimated, and loan agreements. So the point of this slide is that, and this is something that we've just noticed in working with thousands of business owners over the years. A lot of, in my personal experience working with clients, a lot of people just don't know that there are these filing requirements. And if they do know that there are filing requirements, when those deadlines are. So the entity classification election, making that S Corp election to save money on your self-employment taxes, that Social Security and Medicare that we talked about early on. The deadline for that is 75 days after the business is formed. Like I said, there is an exception, so don't panic if you've missed that 75 days. If you set up your LLC, let's say 5 months ago, don't panic about it. But that's the deadline to file it, 75 days after the date of formation. Business, federal, and state personal. So the business tax returns, if you are doing an S corporation, a C corporation, a partnership, so if you have two people in an LLC and you don't do the S corp election, or you do an LLC taxed as an S corporation, all of those forms of businesses are due on March 15th. So we are getting close to the deadline. So if you set up your business in 2023 or earlier, you should be thinking about filing your tax return by March 15th. Now, if you can't do that, again, don't panic. You can file an extension. But you want to make sure you don't miss that deadline, because if you don't file the extension, it's kind of annoying because the IRS didn't used to apply penalties on flow-through entities back when I was first practicing, when I was first in public accounting years ago, probably 2004, 2000 through 2007, 2008, when I was doing business returns. If you missed that filing deadline, it wasn't a big deal because, like we said, flow-through entities don't have taxes at that level. It flows through your personal return, and so if your personal return's late and you paid your taxes late on your personal return, that was. But now the IRS charges. I'm not sure what it is for 2024, but last year it was $220 per owner per month. So if you got two owners, excuse me, and you file 4 months late, I mean, that's thousands of dollars in penalties. So you want to make sure that you are aware of that March 15th deadline if you have elected to be taxed as an S corporation or you have a partnership. Federal returns, Personal returns or single member LLCs that are reported on a personal return, the sole proprietorships, those are due on April 15th each year. Just like the business returns, you can file an extension. And let me mention that the extensions are good for business or personal for 6 months. So, on a business return that's due on March 15th, you can file an extension. You now have until September 15th to file. The personal returns due April 15th, file an extension. Your return is now due on October 15th. So that gives you more time. The issue with your federal extension or your personal extension is that you are supposed to pay your taxes with that extension. So, you may not have finished your tax return yet, but you should at least pay something in, because if you don't pay all of it's an extension of time to file, not an extension of time to pay. So, if you do file a personal extension, make sure if you think you owe taxes that you at least do some sort of estimate or get your accountant to help you with an estimate if you're using an accountant, so that you can make an estimated payment with that. So even if you come up a little short, the penalties and interest aren't bad. If you end up owing, sometimes I'll see a client that owes tens of thousands of dollars and they didn't make, we didn't hear from them, or we had no idea that they owed money. They had a one-time event or something. I had a client recently that had won a lawsuit, and it was taxable, and it was hundreds of thousands of dollars. We didn't know about it. They didn't contact us. They were kind of MIA for a while. Then they came back and it was like, oh, well, now you didn't file an extension, and now it's going to be much more costly because now you have penalties and interest because you didn't make even though we filed the return by October 15th, which was when we filed the extension for, they didn't make the payment by April 15th. So they owed money. In that case, a lot of money. Quarterly estimated taxes. So what that means, if you're a W-2 employee, your employer is withholding taxes every single paycheck, right? So the IRS is constantly getting, and the state is constantly getting money from you. Your employer is withholding it and paying it to the IRS on your behalf. Well, if you're now a business owner and you're the one that's in charge of that, you own the business that's supposed to be collecting these taxes and paying them regularly. And so basically what the IRS says is we want our money at least quarterly. I mean, you can't just wait until April 15th and, pay us, $30,000 in one check and be good. We need to be getting that money regularly so that we can invest it. We can pay expenses of the government, et cetera. Right. So there are things called quarterly estimated taxes that are due basically every 3 months that you have to pay. There's one weird one where it's, the first quarter one's due April 15th, which is the same date as the tax return. And then the next one's due June 15th. So there's only 2 months there, but then it's every 3 months after that. So that's kind of how the quarterly estimated taxes work. And you basically calculate what you think you're going to owe so that you at least are paying something in throughout the year. If it doesn't come out perfect, that's okay. There may be some slight penalties, but they're very small in most cases if you're actually kind of making a good faith effort to calculate what your tax liability is. And especially now that interest rates are a lot higher, the estimated tax penalty is basically the interest on the payments that you should have made quarterly. Back in the day when the IRS interest rate was 2%, I was like, it's not the end of the world if you missed a payment or two, because it's only 2% for 3 months. That's very, in most cases, was very small. Now, now it's up 7. Now the interest rates for the IRS are up 7-8%. Now it's more substantial if you're not making those regular quarterly estimated tax payments. So it's more important than ever. This last thing, the loan agreement. Loan agreements are basically if you put money into the business, the best practice is now if it's $1,000, that's probably not worth doing a loan agreement. But let's say you loan your business $20,000 to get started or $10,000 to get started. You want to actually have an agreement with your business on what the money's going to be used for, when it's going to be paid back, et cetera, as a best practice. And I won't get into that too much, but just know that that's something that you'll want to look at. So I think that is about all for our slides. So I'll turn the time back over. And like we said, we'll try to answer some questions here at the end as well.
All right. Thank you so much, Gary. That was super interesting and insightful. And I know that I learned a lot of things that I definitely did not know before. And I'm sure everyone else did as well. So, sorry, I'm going to change slides. Just a little recap of what we covered up until now before we got into our offer for today. So, we learned many things from how proper entity classification has a significant impact on how we're taxed. We also are so much more aware of all of the many deductions that we can take advantage of as business owners. And we know that all of these topics here that we talked about are super important, especially now that it's tax season. So we just want to remind everyone that we at Taylor Brands, along with 1-800-ACCOUNTANT, are on the same team to help you and your business achieve all of this in the best possible way. So now we can move on to the moment we've all been waiting for, our special offer for today. We're offering 25% off of all of our expert tax services. So this will include our tax services, including business and personal annual tax preparation and filing. And you can now be able to claim this offer from the button that you will see at the bottom right-hand corner. There will be a link to claim this offer, so make sure that you click it, save it for later. We will also be sending out an email along with a recording of the session, and the offer will also be in the email, so no worries. You will be able to access it also later. So make sure that you have this, and you will also be able to access the tax services through your Taylor Brands account. You have the tax and accounting tab in your Taylor account. You will have all the information there. Again, if you have any questions, once we finish doing this Q&A, feel free to reach out to our customer support team. And again, once you access this, our tax services, you will also be able to take advantage of the tax consulting. So more questions will be able to be answered there. And I guess we can continue now with the questions. Gary, are you able to see the questions that
Yes. If I put my glasses on, I can see them. I'm to the age at which I have to use reading glasses, which is depressing. But that's fine. Okay, so here's the first tax question I see is if the LLC for an LLC that has rental property, self-employment tax would not apply, correct? And that is absolutely correct. Rental real estate is a special category of income called passive income, but it's even in passive income, it has a special category of itself. So it is not passive income in general is not subject to self-employment taxes of Social Security and Medicare. So that is 100% correct. So if you're doing just rental real estate, let's say you have a partnership or a single member LLC that owns real estate and it's just for rental, then doing the ECE, the entity classification election, and doing an S corp would not make sense, because the reason you do the S corp election is to save money on your self-employment tax. Now, if you're doing construction, if you're building houses and selling them, that's your core business, that is operating income. If you're flipping houses, so that money would be subject, those profits would be subject to Social Security, Medicare. So in that case, you would want to consider the S corp election. But you're absolutely correct. If it's just rentals, that's the only thing your business does, it does not make sense to do the ECE because it's not subject to self-employment tax. Good question. Okay. I'm an LLC, no member. I'm assuming that means in one member, and I'm a startup. What benefits can I get? So the benefits you get, if you're a startup, let's say I'm assuming that you can clarify, Tanya, if you want, but what benefits can you get? From a tax perspective, the benefits you get are if you have a loss, you can offset other income. A lot of business owners that I talk to have a W-2 job and they're starting something at least on the side, or their spouse has a W-2 job. those losses generated by your business can offset income from other activities. So, if I have a W-2 job and my spouse had a business that lost money, and let's say I made $100,000 and my spouse's business lost $50,000, well, jointly we only made $50,000. So in that case, we're likely going to get a large refund because I've had taxes withheld on $100,000 of income. So those business losses can be helpful. Obviously you don't want to generate losses. They're fairly normal for new businesses in the first year or two. That's a fairly normal thing to lose money. It will at least offset some of your other income to reduce your tax liability overall. Other resources that you may be referring to, other resources, there's grants, the small business, the SBA, you can look for SBA loans. There's all sorts of things that you can try to get access to. But from a tax perspective, which is my specialty, that's the biggest benefit. Hopefully that answered your question. If you want to clarify, feel free. Can you deduct supplies? This is from Ebony. Can you deduct supplies that you donated to a charity or organization? If so, is there a cap at how much? Yeah. So if you're deducting it from a flow through entity, it's, again, it's flowing through to your personal return. So you can deduct supplies or non-cash items that you're deducting to a qualified 501c3 organization, a charitable organization. And basically you deduct it at whatever the estimated market value is of those items. So, obviously if I bought, a bunch of clothes and it cost me $500 when I donate them, and if I've worn them, depending on how much I've worn them, they may only be worth $100. I would get a $100 deduction in that situation. And the organization, the charity that you contribute to, should give you a deduction or a kind of a slip that shows what you donated, the address and name of the organization, and how much the estimated value was. And then you're able to give that to your accountant at the end of the year, or keep it if you're doing the taxes yourself, and you can definitely deduct that on your personal tax return. All right, Justin. Okay, we talked about the home office deduction.
Gary, we also have some more questions in the Q&A tab if you're able to see.
Oh, okay. Yep, yes. I'm looking just in chat. So, okay, yeah, I better go faster because there's a lot here.
Yeah.
Okay, yeah, I don't know how long we want to go, but I'll keep answering for as long as you guys want to stay here. But just one point here. A lot of people ask this question. Muhammad had this question in the chat. If I don't make enough money, do I still need to pay tax? So I'm assuming you mean if I don't have a profit, do I need to pay tax? No, if you don't have a profit, you're not going to pay tax because tax is based on income you generate. So if you don't have any profit, like I said, that's just going to deduct off of your other income. So yeah, don't worry about having a big tax liability if you're not generating income. Now, some states have a minimum franchise tax. Like if you're in California, California has a minimum $800 franchise tax. So that's always fun. But even if you lost money, you have to pay that $800 in California. But federal income tax, no. Question from Casey. If you made zero money but had startup expenses, can I file this amount? Absolutely. And that's a good point. If you lost money in your business, you still have to file a tax return, and you will still be penalized if the IRS finds out you did not file a tax return. So even if you didn't make money, like I was saying earlier, if you filed late and you have one, it's $220 per person per month that it's late. So even if you have a loss in your business and you don't file a tax return, you could have thousands of dollars in penalties, which to me seems ridiculous, but that's how it works. Question from Kezia. If you are a W-2 employee and have an LLC, should you file separately? Does it matter if your LLC means zero, but you have expenses? The same with an S Corp. Okay. So if you had a W-2 employee and you have an LLC, should you file separately? I'm assuming you mean a separate business return. If you do the ECE and your taxes an S Corp, you, by virtue of the fact that you're doing that, you do have a separate tax return that you'll have to file. It's called the Form 1120S for S Corps. You'll have to file a separate tax return. and you'll have to run payroll so that you can pay yourself what the IRS calls a reasonable salary. So that would be a separate tax filing if you do the S Corp election. Obviously, if you're making money, depending on how much, but the more money you make, the more money you're saving in taxes. So the more sense it makes to do that, even though it is an extra tax return. If you had zero money, if you have a loss in the business, it's not necessary to do the S Corp election. You're not going to get a bigger benefit by doing the S election versus having it as a sole proprietorship. So that, that's kind of personal preference. Most people I work with, we just go ahead and do it because the plan is not to lose money indefinitely. So we go ahead and kind of do it from the beginning. So that's just how we're set up. S Corps have a lower audit rate than sole proprietorships reported on Schedule Cs. And there's a couple of other benefits as well. But even though you're not saving a bunch of money on Social Security and Medicare tax, it still provides other benefits such as a lower audit rate. Not that the audit rate's super high anyways, but it gives you an even lower audit rate. I will say that most of the audits I have seen are from Schedule Cs, sole proprietorships on personal tax returns. So, if you're the kind of person that hates dealing with that kind of stuff, it may be worth it, even if you don't have a big gain to do the ECE. All right. We already answered that one because it was also in the chat. Okay, is the ECE also known as the BOI report, or is this something different? So the BOI report is something brand new for this year from the Financial Crimes Enforcement Network, which is basically an association of governmental agencies. And it was basically done to kind of crack down on anonymity in business filings and basically what that means is, people would raise money for terrorist financing or money laundering or things. And so now there's this thing called the BOI that you probably hear about in the news or on radio ads and things. And basically that is just an ownership information report, business ownership information report. That's all it is. So you're filing something with the government saying, hey, government, I set up an LLC, ABC Consulting LLC, that's me. Gary Milkwick, my address is this, and I own 100%. So it's literally just telling the government who owns the entity and their contact information. So that is different than the ECE, which is the entity classification election, which is choosing how you want to be taxed. So they're two completely different things. All businesses will have to file that BOI. Business ownership information report this year. So if you set up your entity in 2023, by the end of 2024, you have to file that thing. I know we're filing that for all of our clients who have one of our packages, just kind of as part of what we do for them. But yeah, that's definitely something that you will need to do this year. Okay.
And Gary, I think we're going to take one last question.
One last question. Okay. Yeah. Let's see. Sorry, we're not going to get to all these. All right, I guess I'll just do the next one in line I'm on. Can you depreciate the vehicle and still claim mileage or have to do actual expenses? If you're depreciating the vehicle, that's part of the actual expenses model. So you can't depreciate the vehicle and do mileage. That would be part of two separate methods. So hopefully that's clear. Yeah, and sorry I wasn't able to get through all of those. But if you guys talk to any of our reps about have a consultation with them, they should be able to answer questions as well. So hopefully that's been helpful.
Thank you, Gary. And yes, we will be happy to answer the rest of your questions. Also ones that maybe you haven't asked yet, or if you're watching the recording and you also have questions, feel free to reach out to us and take advantage of the consultation services once you claim our offer. Just a reminder, the offer along with the recording of the session will be sent out to everyone tomorrow. And we really hope that you all join us for another one of our webinars, hopefully soon. So thank you all for joining us. Have a happy tax season. We wish you the best of luck with everything, and we hope to see you soon. Thank you so much. Thank you, Gary.
Thank you.